Hi everybody, welcome to our DAT IQ weekly market update. This is an update for November 11, episode 362. I'm Dean Croke, market analyst here at DAT on Veterans Day. No guest today, it's just me. Today, of course, is Veterans Day, where we honour all military veterans, that is anyone who has served in the US Armed Forces. Of course, today you'll see ceremonies at war memorials, parades in many towns, and moments of silence around 11 a.m. today, which of course began as Armistice Day, marking the end of World War II. Of course, that was when the ceasefire began between the Allies and Germany, which took effect on the 11th hour of the 11th day of the 11th month, way back in 1918. All right, let's dive into our freight market update today. Spot rates mostly flat last week, and after the gap between this year and last year widening in October, that's starting to close now as we move into the middle of November. The reefer forecast, which we'll get to towards the end of the show, is showing some sub-seasonal softness, highlighting the soft underbelly of the current freight market at a time when the market should be pumping, no doubt impacted by the federal government shutdown and the on-again, off-again SNAP benefits. However, the Supreme Court ruling over the weekend and the Senate's agreement on Sunday evening, of course, that to end the shutdown, we could be back in business. Could be some consumer confidence come back into the market and a little bit more volume. But we'll see if the House agrees to end the shutdown officially this week. Currently, it's the longest government shutdown in US history, and that's no doubt been impacting volumes in the spot market. On the manufacturing front, domestic manufacturing appears to have stalled, according to the ISM PMI reading, which came out last week at 48.7. That's indicating that the manufacturing sector contracted for the 8th consecutive month. Manufacturing respondents across nearly all sectors reported a severe lack of demand and customers actively cancelling or reducing orders due to domestic economic uncertainty. Zach Rogers' Logistics Managers Index for October came out at 57.4, largely unchanged in September, but it did signal a continued moderate expansion in the US logistics sector, moderate being the key word, notably after 2 months of a freight inversion where capacity had increased and prices had dropped. There was a slight return back to more normal market activity. So that freight inversion that we've talked about actually reversed course. Class 8 truck orders, according to ACT Research, were down 21% year over year. A notably weak number when you take into account October is seasonally the strongest month for orders when next year's backlogs start to get built. Private fleet numbers down also. Year-to-date orders down 38% year over year in the private fleet sector. And Bill Cassidy's truckload capacity index from the Journal of Commerce came out last week, down 3.6 percentage points quarter over quarter at 72.4%. That's an all-time low for the index, which of course goes back to prior to the Great Recession, indexed to 100 in 2006. It's a great read. It was published last Friday. The previous all-time low for the index was about 73.8. So this is interesting. Large truckload carriers still haven't found bottom in terms of truck counts on highway. This tells you that carriers are still dropping their fleet counts to try and find basically, equilibrium where loads equal trucks. We suspect that we're starting to see some real softness in the large contract freight market. All right, this week's market update will be out this evening at dat.com/market update. Let's dive into a slightly abridged version of that report, starting with the market condition index for dry van. In the first week of November, essentially the dry van load to truck ratio was down to 5.83, indicating an easing in the spot market. Not unusual for the first week of a shipping month, but it did show some noticeable softness. Only 6 of the 135 freight markets that we track in the spot market showed increases in load post volumes. Notably, though, load post volumes in our top 10 freight markets, which account for a quarter of our national volume, they plunged 16% last week. Big markets like Atlanta, that was the number one dry van market last week, saw a 19% drop in load post volumes, rates down a penny per mile to $1.59 for outbound loads. Remember, that's the 7-day rolling average, excluding fuel. In Houston, that was the second largest freight market last week in the spot market. Volumes down 14% last week. Chicago was the third largest market, down 11%. Dallas was the fourth largest. Volumes plummeted 30% last week. Rates down a penny per mile, settling at about $1.42. Some real softness in the Dallas-Fort Worth Metroplex last week for both reefer and dry van. In the refrigerated market, the temp control market experienced some uncharacteristic weakness last week, despite a national increase of less than 1% in load post volumes. The top 10 markets, which accounted for 23% of national volume, saw a 15% decrease in volume. Big markets like Atlanta and Chicago, volumes were down 12% last week. Dallas, as we just mentioned, significant week-over-week change in load post volumes, plummeted 27% last week. So some real softness in the reefer market, no doubt impacted by the on-again, off-again SNAP benefits program. In the flatbed market, seasonal slowdown last week, again, as we head into the cooler months. Top 10 markets, which represent 30% of our national load post volumes, were down 21% last week. However, there were some regional areas of capacity tightness. Portland's been tight for about a month last week. Rates were up 30 cents a mile for outbound Portland loads, averaging $2.36. They were down for the last 3 weeks, so they've reversed course as we get into that early Christmas tree shipping season, which starts to ramp up as we head into Thanksgiving. Similarly, Houston experienced a 3 cent per mile increase last week for outbound flatbed loads. They were up to $2.04. Jackson, Mississippi, spot rates surged last week by 30 cents a mile to $2.85, but mainly on regional lanes to Dallas and Nashville. All right, let's have a look at our year-over-year look at spot rates, starting with dry van. A slight decrease last week, falling by just under a penny per mile to an average of $1.69. Despite this dip, the current average for week 45 is 3 cents per mile, or about 2% higher than the same period last year. It's about 2 cents per mile higher than the 3-month trailing average. However, if we look back over the last 10 years for week 45, last week's 7-day rolling average was about 2 cents per mile higher, or about 1%. So within about, a couple of pennies of where we would expect it to be over the long term. So pretty much on track. The average rate for DAT's top 50 lanes, based on the volume of loads moved, down 2 cents last week to $1.98. In our bellwether states, which represent about half of our load volume, that's loads moved, remained unchanged at $1.94 per mile last week. Let's have a look at our refrigerated market. The national 7-day rolling average clawed back some of the prior week's losses, increasing by a penny per mile last week to $2.09. Remember, that's the 7-day rolling average excluding fuel. Compared to last year, the reefer rate is 2% or 4 cents per mile higher, but it's also 3 cents or about 7% higher than the week 45 average over the last decade. And lastly, in the flatbed market, for the second consecutive week, the 7-day national average remained fairly stable, closing last week at $2.05. That represents about an 8 cent per mile or 4% increase compared to last year. The spot rate also surpassed the 2017 rate by 4 cents a mile and was about 7 cents per mile or 4% higher than the week 45 average over the last decade. All right, let's wrap up our weekly update with some short-term 35-day forecasts according to Ratecast, which is in green. The forecast is bounded by the yellow and red lines, which are our upper and lower error bands. The blue is the 7-day rolling historical average. Remember, these are our line haul rates excluding fuel. These are the forecasts for 550-mile loads. So really line haul only, long haul forecast. Let's start with dry van. The 35-day takes us out to December 12. So we're starting to get into that 2-week period before Christmas, when we typically start to see some last e-commerce and temp control shipments. But of course, it spans Thanksgiving also in the reefer sector. Let's start with dry van. Ratecast is expecting rates up 7 cents per mile out to December 12, up to about $1.76. That'll be about 3 cents per mile higher than where they were last year. Low case has rates flat. High case has rates up 14 cents a mile. I think Ratecast is pretty well on track with where we were last year. In the refrigerated market, though, the Ratecast is expecting rates to cool down significantly. I do think, though, with the federal government shutdown, we will start to see that market pick back up. Of course, that's assuming that the House passes the agreement, they can reach terms, and that we start to see some activity and SNAP benefits get back on track. The reefer forecast has rates out to December 12 at 202. That'll be about 2 cents per mile higher than where they were last year. So the net out to the 35-day mark is down 5. But they will be up about 3 cents a mile out to Thanksgiving at $2.12. But before dropping off out to December 12. So I think what we'll see is in the next week, this forecast will start to change, assuming we see the shutdown over, and then we start to see some of that early Thanksgiving volume around hams and turkeys, and of course Christmas tree season start to pop into the forecast. In flatbed, lastly, flatbed has rates up a penny out to December 12 at 206. Forecast remaining relatively strong. Compared to last year, forecast has rates up about 11 cents per mile higher than where they were last year. At December 12 last year, they were $1.95. This year, the ratecasters has it out to about 206, up 11 cents. High case has rates up 4, low case down 3. So a fairly tight forecast in terms of what ratecast is thinking. So it looks like still a pretty good year holding for flatbed carriers. All right, that brings us to the end of our market update this week. Remember, you can go to dat.com/market update and get the long form version, including some charts from today's forecast. A couple of shout outs. Make sure you tune into Radio Nemo and the Road Gang radio team every day at 7 a.m. Central on iHeartRadio, Facebook and YouTube Live. I'll be on with Dan Deegan tomorrow morning on Logistics Live. Chris Kaplis is talking to John Motley from LogNet about how AI is impacting tariffs. Next week, we have Brad Bentley from Fastport. He'll be on our show, very important show, talking about how they're talking about recruiting in the veteran space. Make sure you set up alerts for our live show. Subscribe to our show for next week. And with that, another show's in the books. Thanks for watching. Be safe. Be nice to everyone. We'll see you back here again at 10 a.m. Eastern, 7 a.m. Pacific.